Good morning, everybody, and welcome to our latest webinar, Employee Ownership Trusts, with our MD, Angela Wood. This is a half an hour topical webinar. So what we'd ask you to do is if you could please just pop your questions in the Q&A section, and we will download them after the webinar's finished and get back to you with all the answers at the time we send out the recording and the slides. Thank you very much. Over to you, Angela.
Thanks, Sarah. Let's just start my video. Hopefully everybody can see me. Great. Well, morning, everybody. Sorry, we're just waiting for a few more to join. We've actually had about 72, I think, is signed up. So we wanted to give an opportunity for a few more people to join this morning. So thanks for waiting there for a couple of minutes. So as Sarah says, we've just got 30 minutes today. So it will be a bit of a whistle stop tour through employee ownership trusts. The idea today is not to give, an overly technical overview, although we will obviously be talking about tax because that's what we're here for, and just really to give you, some highlights, as it says here, good, bad, and the ugly of EOTs, to give you some food for thought, really, for yourselves or your clients if you are thinking about EOTs as something that might be relevant. So let's start. So just before we start, let's have a quick introduction to EOTs Tax. Some of you, I've had a quick look through the list of attendees, so some of you will know us, others don't. So just a brief introduction to EOTs Tax. So we are a team of tax experts. We provide specialist tax advice on a range of complex tax issues. And we cover all advice around all UK taxes, all main UK taxes. So what I mean by that is we don't get involved in things like landfill tax and kind of really quirky taxes, but everything else goes. So as listed there, income tax, etc., stamp duty, land tax, and of course VAT, which is often something that people don't like to kind of dabble in. So we support individuals and businesses directly and engage directly with those normally SME businesses and their owners, as well as supporting other professional advisors, either through providing project or consultancy work or through our Tax Partner Pro subscription service. And we've just gone there, ask for details. If you don't know what that is, then feel free to email and find out more. Brief introduction to me, very briefly again. Some of you know me, some of you don't. I am Angela Wood. I am the MD of EOTs Tax. I'm also a chartered tax advisor, and for my sins, I'm also an ex-lawyer. So I practiced tax law for around 10 years. That said, although I was doing lots of M&A transactions and exits and sales from businesses as a tax lawyer, EOTs didn't exist when I was practicing as a lawyer. So they weren't something I saw in practice as a lawyer, but obviously we've done a lot of work with EOTs, with clients wanting to exit by way of an EOT at ETC. So that's, where we've got involved recently. So what is an employee ownership trust? Well, the definition is, well, I say the definition, the employee ownership trust is a trust, as you might expect, which holds shares in a company for the benefit of its employees. Some of you may have heard talk of EBTs, Employee Benefit Trust, in the past. An EOT is a form of EBT. Lots of acronyms in tax, aren't there? So it is a form of EBT, but with more stringent criteria, really. So sort of evolved from the EBTs as were. EBTs, as you might know, have had quite a negative press over recent years, whereas EOTs, really getting some really positive coverage in press, and rightly so. So one of the conditions, the first condition that needs to be satisfied for us to be thinking about EOTs is that the EOT is only available to trading companies or holding companies of trading groups. So investment companies don't qualify for EOT treatment or to sell to an EOT. The other thing to mention is that although we talk a lot about employee ownership and employees having a stake in the business, the employees themselves are not shareholders. They don't hold the shares directly. The shares are held by the trustees or by the trustees on behalf of the employee ownership trust and for the benefit of the employees. So the employees don't hold shares directly. They're not registered as shareholders at Companies House, for example. The key thing here, and I'm sure this is something you're probably a lot of you well aware of, is that trust, once we've gone through this process of exiting and selling out to an EOT, the trust must own more than 50% of the shares in that trading company and the voting rights, etc., to qualify as qualifying this employee ownership trust. So what we're talking about here is a disposal of a majority interest in the company to the EOT. It must be a majority interest. We'll come back to that later, because although that is one of the key conditions to benefit from some of the main tax reliefs, or the key condition, I suppose, Clients can struggle to get their head around that a little bit, the fact that they are giving up control, but we'll come back to that later. Mention that also in the next point there is a separation therefore of ownership and management. So as I said before, the trustees are the owners of those shares and they have a duty to act in the best interest of the employees, and they will have a sort of an oversight role. And again, we'll touch on roles of trustees a bit later. But it's the management that continues to run the business day to day. So the management will continue to take the day-to-day decisions, but the trustees will get involved in certain more fundamental decisions, I suppose, and have a sort of a general governance and oversight role. And again, that will all be set out in the employee ownership trust deed and some of the sort of the articles of association and things about governance of the company as to what the trustees do and don't get involved in. Just a few stats as well I wanted to share with you. I mean, it's fair to say that EOTs have become really popular of late. I say of late because EOTs were introduced by Finance Act 2014. So they were sort of, I think Royal Assembly was July 2014. So they've been around for just over 10 years now. It took a while for them to gather momentum, but as of, and this says 31st of October 23, there were in excess of 1,650 employee-owned businesses in the UK. And depending which stats you look at, but the stats that we've got here, approximately 330 new employee-owned businesses in the last 12 months alone. So it's really gathering momentum. And I think if you look back, I think that there's been something like a 16% increase year on year in the number of companies going into employee ownership. And in fact, I think 1 in 20 now private sales are to an employee ownership trust. Again, we'll touch briefly later on the sort of options for exit. That's not what this webinar is for today, but in terms of private sales, 1 in 20 to EOTs. Really important stats here, and again, this comes back, I suppose, to the fundamental principles of why a business may want to sell out to an EOT in terms of that employee engagement and getting the employees a sort of seat at the table, if you like, in general terms. So the employee ownership companies have reported 57% increase in profits, 83% reported increased employee engagement, and 73% reported increased job satisfaction. So obviously that's fantastic, as you know, if you're going into this for the right reasons, which we hope clients are, then that's exactly what you'd be hoping to achieve. Let's now look then at some of the good points around EOTs and why these can be a really good thing. So on the last slide, we threw some stats out there, but the idea really, or one of the ideas behind an EOT, or the main idea really, is that it drives productivity through more engaged and motivated employees. As I said, the idea here really is that the employees have a say, they have a voice, and they have a seat at the table, and they have a vested interest in making that company a success story. EOTs are often as well and do protect the business owner's hard-earned legacy. So culturally, when people are thinking about an exit, and again, I'll come back to the sort of various options for that now, but one of the things that they're thinking about is the culture and the legacy that I've built in this business. Can I protect that when I exit the business, and how do I do so? So briefly touching upon obviously the options for exit, so that's not the point of today, but when thinking about an exit, we've obviously got a trade sale, so sale to a third party, usually, you know, someone that comes through a broker or someone that's just there in the marketplace looking to acquire business, sometimes competitors. Clients will also look at MBOs, management buyouts. Those can work and do work well, but can also be fraught with challenges post the exit of the original sellers. And really, then we've got this option of selling to the EOT, which for a lot of business owners, and you can put some quite sort of stringent stipulations into the sort of the way that the trust is governed about how you want that company to be run post your exit. Essentially, there was one that we did for a client, and they were really keen to ensure that, for example, they'd been really heavily invested in new technology and making sure that they were constantly innovating, and they really wanted to make sure that that continued post their exit. So although you can't force that upon the future owners and managers, putting those sort of values-based objectives into the sort of the trust governance documents and things can really help to ensure that you maintain and keep up the legacy that you want for that business. The other thing for EOTs is that it allows the leadership succession to occur over a period of time. So we said that the majority share in the business must be sold to qualify for the beneficial tax treatment. So 50% or more must be sold to the EOT. However, the leadership can and often do stay on in the business. And so they have a period of time where they are sort of handing over gradually, I suppose. We'll talk a bit about consideration later for the sort of the sale of the shares to the EOT, but there's often a deferred element of consideration when selling to an EOT, because there quite simply isn't the cash there on day one for the EOT to pay for the exiting shareholders' shares. So the leadership will often continue over, sometimes over a period of even 8 to 10 years. We have seen clients wanting to go even longer again, which we'll come back to later. But they are there to sort of handhold the new management team through that process. And it's quite a nice, easy transition into succession. So that's quite nice. Clearly, a key advantage of the EOT is that the business owners can access the value they've created. So again, mentioned earlier about the fact that there is often a deferred element, but there's often a cash element to this. So on day one, the cash sat in the business can and often is paid to the exiting shareholders, or a good chunk of that is certainly leaving some often for working capital, clearly. But that value that the business owners have created over a number of years can be accessed. And again, we haven't touched upon tax just yet, but that can be accessed tax-free. So we'll come back to that in a later bullet point. Coming on now then to the tax points. So key tax points here, and these are the really kind of exciting things from a tax point of view, I suppose, is that coming back to the point of employees engaging in the process and really getting on board with the fact that they have a stake in this business, we can, once we're in an EOT situation, we can pay annual tax-free bonuses to employees of up to 3,600 per annum each, which obviously is quite attractive for a lot of employees. The key tax relief, however, is the fact that on exit to an EOT, the capital gain that would otherwise arise on the sale of the shares by those exiting sellers will be potentially, if the qualifying conditions are met, subject to tax at 0%. So no capital gains tax to pay on the disposal of the shares by those sellers, which is obviously huge. And I think what we've seen recently in terms of the increasing popularity of EOTs and the number that we're doing and that we know other professional advisors in the industry are working on, is that because there was the change to business asset disposal relief, taking lifetime gains from 10 million to 1 million, so that's no longer as attractive as it once was, and being able to access that 10% capital gains tax rate. This is where obviously EOTs have become increasingly popular. Clearly, a 0% rate is even more attractive, and that's why we think we're seeing a lot more of this in recent years. Just one point to make on that is that it is we put here one-hit wonder, but what we mean by that is that only sales to the EOT in the same tax year will qualify for that 0% tax rate. And if you think through that logically, the reason for that is because there has to be a disposal of a majority interest in that company to the EOT at the point of that exit. So we've got to be transferring at least 50% to the EOT. Clearly, let's say you've transferred, I don't know, 52% to the EOT. If you come to do that again or try to do that again and dispose of more shares to the EOT, there won't be that controlling and majority interest left to qualify for the 0% tax rate. You can still sell more shares to the EOT if you want, but as I say, the sellers won't qualify for that 0% capital gains tax rate. So that's one point to mention there. Let's have a look at some of the sort of the slightly, we said bad, more negative points, I suppose, around an EOT. I mean, they're not necessarily negatives if managed correctly, but it's just worth pointing out some of the challenges, I suppose. So the first thing to say is there's something called this limited participation rule. So we're not going into the really technical detail of sort of qualifying conditions and things here today, but what that means broadly is the sellers can't benefit from the trust, so can't be beneficiaries of the trust. I mean, it stands to reason when you think about it, because the sellers have had their their cash out and will be getting deferred consideration. So it's the whole kind of cake and eat it thing. And there would potentially be a conflict there. So the sellers can't be beneficiaries of the trust. That would prevent the relief being given, essentially, if that was the case. Another key point is that the original sellers must lose control of the company. We've talked about control already a lot this morning. And clearly the idea here is that there is an exit taking place. The sellers are exiting the business or will be exiting the business over a period of time. So whilst that's not in itself a bad thing, there is a big sort of mental adjustment to make. Just to sort of touch upon a case that we've worked on recently. So we worked with some clients who operate in the energy sector, and they were looking at an EOT as a route to exit. However, having spent probably, I don't know, 4 or 5 hours talking to them over a number of weeks, having given some initial advice on the EOT and how it would work and what it might look like, they really couldn't get their heads around, quite honestly, the fact that they were giving away control of the business. So there were lots of questions coming from them about, well, what decisions are we able to still make, and where will the trustees be involved, and will they be able to veto us, and what happens if we want to do X or Y? You know, will we be able to just have that free reign that we had as business owners? And the answer is no, that you won't have free reign, because you are accountable as the management or the exiting sellers to the trustees and the trustee board. So we have got actually a document which we could share. Sarah, maybe send that round as well. No need to jump in, Sarah. We'll maybe send that round, which is a document we put together primarily for that client, actually, but which we've used for other clients around, again, it's not War and Peace, but some of the roles and responsibilities of trustees and when they might be expected to get involved, although that will very much depend on the individual trustee and what's agreed as regards to the trustees' specific roles. So just a note on trustees as well, really. The exiting seller can be a trustee of the employee ownership trust, and often is one of the trustees is often an exiting seller. You then generally have an employee representative or a couple of employee representatives on that trustee board, as they are the ones that will be putting forward the sort of the views and opinions, I suppose, of the employee group as a whole. And then really what you'd be looking to have is an independent or a couple of independent trustees. That could be a corporate trustee, or it could be an individual that is an independent trustee. For EOTs Tax, we've got a number of independent trustees that we know and have worked with and have put forward for clients who weren't sure where they wanted to go with that. So if they weren't sure who they were going to use, we can assist with that. So yeah, there is a board of trustees that decides how that EOT is run, or how the company is run, I suppose, and governed. Another key issue is around valuation. So clearly, when we're thinking about an exit in any context, we have to think about valuation of that business, and what that is, and a reasonable valuation in any situation where there is an exit. The valuation has to be real, and if it isn't, the HMRC may seek to challenge the valuation that has been applied to that business. In this instance, if HMRC suspect that the valuation has been overstated in respect of the sale to the EOT, they will try to tax the excess potentially as employment income. So you're going to go from a position whereby the sellers are getting a 0% CGT rate to potentially having to pay income tax on the disposal of shares, which clearly is not a position that anybody wants to be in. So valuation is key. We're not here today to talk about valuation, or again, it is something we can help with, and we do assist clients with valuations. EBITDA has been a particularly popular method of valuation recently, and sort of multiples of that, depending on which sector clients are operating in. But you know, valuation and an independent valuation, getting an independent valuation is critical. If you are falling foul of that you know, overstated valuation from HMRC's point of view, then you'd be looking at the disguised remuneration rules broadly, which we're not going to go into today, because everybody that knows anything about tax will know that they are very complex in their own right. But essentially, that means, say, that the sale or part of that would be taxed as income. We talked about the tax-free bonuses for employees, and again, they are obviously one of the key benefits for you know, tax release for EOTs. But there are some rules, restrictive rules around how those payments, tax-free payments to employees, can be made. So all employees must be able to benefit from these tax-free bonuses on the same terms. And when I say the same terms, there are some variations that can be made. So we don't have to pay the same amount to each employee. There can be variations around things like how much they're paid, remuneration, their length of service, or the hours worked. And you can also exclude those that have joined, I think, in the first 12 months, for example, from benefiting from those tax-free bonuses and the EOT more generally. But in general terms, the EOT is for the benefit of all employees. So there's a limit to what you can do to differentiate that. And again, if you're not careful with that, then you can end up losing your EOT status, which clearly nobody wants to be in that position. And we'll talk on the next slide about what that means if the EOT status is lost at some point after exit, which is actually my next bullet point. So next slide is headed the ugly. So this is, I suppose, just the stuff to be really, really kind of careful around. So the tax benefits we've mentioned, the 0% CGT rate, but also the tax-free employee bonuses can be withdrawn if the EOT loses control of the company or ceases to trade. So we've talked on the way in about there being various qualifying conditions, but also you've got to be kind of monitoring that post sale and post exit as well to make sure that those you're not falling foul of those sort of disqualifying conditions. So if this happens, then in the initial period, which is the period up to the end of the tax year following the sale, the sellers will be paying CGT at the normal CGT rates, whatever those might be. So if they can still access business asset disposal relief, then that would still be in play. But if not, they'd be paying at the normal CGT rate and not the 0% rate. After that initial period, the EOT will be deemed to have sold the shares at the market value at the time the control is lost. So the EOT will be the entity that suffers the tax charge after that initial period has passed, not the sellers themselves. But the EOT will have disposed of those shares at market value. And the challenge there is it's unlikely to have any cash. So when it's faced with a large tax bill or could potentially be faced with a large tax bill, then that's going to be a bit of a challenge if there is no cash to pay that tax bill. Another thing to think about, and we've got a note, I think, on the next slide on sort of so-called second exits. But if there is a sale by the EOT, the tax rate that the EOT will pay is very high. And the reason for that is because when the EOT acquires those shares, it assumes the seller's base cost, the existing seller's base cost. So at such point as it disposes of those shares, it will pay the full amount of tax on the full capital gain. So not just the bit that's occurred since it acquired the shares, but going way back to when the exiting sellers first acquired those shares, which could be, of course, at nominal value, for example. So there could be potentially a huge capital gain that EOT is sitting on. It basically stands in the shoes of the exiting shareholder. So that is something to be mindful of, that whilst the exiting shareholders have got a kind of good deal in the sense that they have achieved a 0% tax rate, the EOT, if it comes to sell the shares, on the other hand, has a significant tax bill potentially to pay. Also noting that any distributions to employees via the EOT would be taxed as employment income. So that's just something to bear in mind at that point. Once if and when the shares in the EOT are sold, then those distributions, any distributions made to employees as a result of that sale will be taxed as employment income. So again, not particularly attractive. The other thing to think about really is, would the sale be right for the employees? So we haven't seen, I'm not aware, I don't know if others on the call, on the webinar have seen this. I'm not aware yet, personally or anecdotally, of anyone having gone through a sort of second exit as such, having gone into employee ownership, so selling out to, I don't know, in a trade sale, 4 or 5 years after an EOT has taken place. I mean, it will start to happen, of course it will. And there was some sort of talk in the press recently about John Lewis, which of course is one of the most known examples of an EOT, whether they were going to think about a possible trade sale, although I think the chief exec has come out recently and said absolutely not. The plan is for that to absolutely stay in employee ownership. But yeah, so just thinking about, would a sale be right for the employees? Because say the EOT has to act in the best interests of the employees, and the trustees do. So thinking about what that looks like for them on a potential future sale, as well as I put here on the impact on any shares retained by sellers as well. One of the other key disadvantages, I suppose, from an EOT, from going into an EOT, is around inheritance tax. And this is one that's not often discussed, although again, we've had a recent example of this with a client that operates in advertising and PR. So the exiting shareholder in that situation, I think she was around late 40s. Well, there were two actually. One of them was late 40s, and I think the other one was probably a bit older, maybe late 50s. But as I've explained earlier on, it's very common for there to be a cash lump sum initially, but then for a large element of the agreed sale price to be deferred and to be paid out of future profits. That's really, really very common with an EOT. The challenge there is that the full amount of the deferred consideration would be subject to IHT on death in respect of the selling shareholder. So even if that's not been received for years. So in the situation that I mentioned with the advertising PR company, one of the shareholders there was, to say, in her late 40s. They were talking about the period of time over which the deferred consideration would be paid. And I think typically for most EOTs, you're looking at sort of an 8 to 10 year period, whereas they were sort of looking to perhaps push this out to 15 years, maybe at one point even in excess of that. What we wanted to make them aware of, really, I suppose, is although one of the shareholders was in their late 40s, the other one was, I think, in their late 50s, and a potentially longer than 10-year period could cause a problem for IHT if they, died within that period, and then ultimately that IHT became payable immediately, having not received that deferred consideration. So, I mean, you could look at, or clients could look at insurance for that IHT exposure as an option for that, although that is likely to be expensive. It's not something that we've been asked to look at. Not, we wouldn't be obviously putting that in place, but being asked to kind of source for clients. So I'm not sure of the cost on that, but I imagine that would be potentially quite prohibitive. Few practical points then. So there is an HMRC consultation at the moment. That actually closed, I think, around the end of September 23, but we haven't really heard, as you might expect with consultations, we haven't heard much more on the results of that yet. So we're waiting to see what kind of the findings of that were. However, a couple of points coming out of that. So the HMRC are likely to be in the not too distant future mandating that the trust is UK resident. So that's something that we think is going to come. And then we talked earlier about the sort of trustee board and what that might be made up of, or what that might look like. And we believe that one of the things we know that one of the things that was in the consultation was that HMRC would like to mandate that the inclusion of at least one independent trustee in that body of trustees. Which you can understand why that would be relevant, and say making sure that there is that independence and that the trust is acting in the best interests of the employee group as a whole. Another couple of points here. So there's something called the contribution to fund consideration. So what that means is that, again, thinking about cash coming out of the EOT, of the company to the EOT, for the EOT to make those deferred payments of consideration. Obviously, that money has to be available in the company to be paid up to the EOT, for the EOT to pay the sums that are due, and really those contributions are likely to be limited to the level of distributable reserves in the company in the way that you would normally expect if you're wanting to pay dividends, that there would need to be sufficient distributable reserve for those dividends to be paid. So there is a risk there that those contributions to the fund, to the EOT, will be treated as dividends. But again, you need to seek specific accounting and tax advice on this if in any doubt. So that's just something to point out. Another point there is that regards payment of dividends to the trust, that's very tax inefficient. Payment of dividends to any trust is very tax inefficient. Getting dividends out through a trust is just not something you want to do from a tax point of view. So just something to bear in mind there. And again, we've already touched upon this, but the longer the period for the deferred consideration, the greater the risk of the seller, really, not just from an IHT point of view, but ultimately that consideration doesn't get paid because obviously you're relying on the company's performance being maintained at the level that was anticipated for a much longer period. So that's something to bear in mind. Finally, the last point here, and it really is key though actually, is that employee communications, as we said here, are key to reaping the business benefits from EOT. Again, it's something we've helped clients with in the past, as being part of the sort of panel of people that sit in front of their employee group, either at or just before the point of sale to an EOT, to talk about what's in it for them ultimately, but what's expected of them and what it means for them really, and what it means to be in employee ownership. And really getting the employees on board, as we said, and we've seen the stats about, engagement and employee ownership companies talking about there being, really good engagement in those companies, but really getting those messages out to employees as early as possible is critical, really. And again, working with independent trustees to help that process, is where you want to be. Last slide, I know we're coming up to time here, but last slide then. So whistle stop for this. So in summary then, so we've said there's a lot of positives, clearly, if implemented for the right reasons. But again, we get a bit kind of carried away, and obviously I work in tax, but we get a bit carried away with the tax, gosh, 0% CGT, and it is huge. But it's got to be done for the right reasons. You've got to get your head around, or sellers have this idea that they are giving away control of the business and that they won't have the same level of control that they had previously. You've got to get your employees engaged, as we've said before, and get them on board, and just, really make sure that the clients are going into the right reasons. And say the energy company we looked at ultimately decided it wasn't for them right now because they weren't ready to give up control of the business. So that's something to bear in mind. We talked briefly about some of the qualifying criteria, although we haven't gone into detail on that at all today. Simply don't have the time, but we know that if you fail one of these qualifying criteria, and also if you end up with a disqualifying event post-exit, then that can be expensive and can cause major problems. So the message there is obviously take specialist tax and legal advice. I haven't mentioned, but should mention, that clearance is part of this process. So getting HMRC clearance primarily that the income will be taxed, also the disposal proceeds will be taxed as capital gains and not as income. That's the main clearance that we seek, but also that those qualifying conditions are met. That's critical, and that's part of the process that we would always recommend for clients, and part of what we do for clients is to go through that clearance process with HMRC. And we've also already talked about this, that second exits can be problematic, particularly where the owner retains a stake post the EOT. So the initial slice of the sale process will go to settle the deferred consideration. But as we said earlier, the effective tax rate on the balance paid to employees can be very high. And as we said earlier, also trustees must assess if the sale is in the best interest of the employees. So that's something that, second exits will be interesting, and we're watching this space with interest really to see what those second exits might look like as they start to arise over the next few years. So that is the end. We've just about ended on time. We started a couple of minutes late and we've ended a couple of minutes late. But thank you very much for listening. Obviously, there's lots and lots we could talk about with EOTs. We just simply don't have the time today. But please do send your questions, as Sarah said at the start, via the Q&A chat or indeed by email afterwards. And we will deal with those over email, and we'll send all the questions around that people ask. So you've got all of those with the slides and the recording. And just a note of our next webinar, which is actually next week. We don't normally have some that follow on quite as quickly, but the next one is next week, Thursday the 19th, preparing for life after an exit. So that could be an exit via an EOT, but maybe via a trade sale or whatever. And it's actually the third in our series of webinars around succession, which the others are also available on recording if you want those. So please do check that out, and please follow us on Eventbrite. And thanks very much for listening. Thank you.